Hi, good friends. So welcome to this segment. We'll be looking at risk-based auditing. But before I start with the risk-based auditing topic, I want us to look at the concept of business risk. That will form a key part of our discussion today. So every business faces risk. Okay, every business faces risk. Even the audit firm faces risk. Okay. So when we talk of business risk, what do we mean? We are talking of the risk that affects the company. So the risk that pertain to the company as a result of its everyday activities, okay? As a result of its everyday activities, as a result of the operating environment in which the company thrives, okay? Yes. And then the management style, okay? The responsibilities of the management. So when we talk of business risk, those risks that affect the company as a result of their day-to-day activities, okay, as a result of the management style, the management function, their responsibilities, how management reacts to any perceived risk or how they plan towards the future, okay, and then the operating environment in which the company finds itself. So the audit firm itself faces some risk. We will not be looking at how the audit firm manages its own risk. We are looking at how the audit firm will conduct a risk-based audit in line with the company to ensure that the company can safeguard its resources, its activities into the foreseeable future period. One thing I also said is the Unit 4 section of our model is the heart of the auditing model, okay? Well, we're talking of audit evidence here. We are talking of audit evidence here. We are talking of audit evidence here. Planning also comes in here, okay? Testing also comes in here. We will delve deeper. If you pick the ACCA text, look at chapters 5, 6, and 7, and 8. Yes, chapters 5, 6, 7, and 8. You see risk there, you see planning, you see evidence, you see systems and controls. Those are the hearts, okay? And so usually you encounter questions on this area where even in the professional exam, those of you who do the advanced audit and assurance, you'll find it there. Okay. So at this point, I want us to delve deep into it and see how best we can go into it. All right. So we are looking at risk-based auditing. That has become the norm of the day. Auditors today going to conduct their audit using a risk-based approach. Okay. In the past, it used to be materiality-driven, but now it is more of risk-based. Okay. It's more of risk-based, and that's the new movement in terms of audit. So what we're going to do is, we know what business risk is. How do we differentiate it from audit risk? I'll just tell you here. So we know what business risk is, the risk that can affect the business as a result of its daily activities, the operating environment in which the business thrives, okay? And then the management actions and responsibilities. Audit risk is a function of 3 items: inherent risk, control risk, detection risk. So they are different. They are totally different, okay? Audit risk, the risk pertaining to the auditors not able to drive or arrive at the correct conclusion because possibly they couldn't do some good job over there, okay? Or they were limited in scope and they still proceeded with their work. Now, I want to see the difference in the purpose of the risk assessment between the 2 approaches. And to be able to understand this, remember, the main thing we have to look at is to leverage on ISA 315. Okay, understanding the entity and its environment and its operating environment, so that we'll be able to assess or identify risk of material misstatements or error. Okay, so you understand the business, its operating environment, then you can better understand the business risk that affects them. There are sources of risk that affects the business, sources of business risk, let me put it that way. We have internal, we have external. Okay, external shocks, normally we cannot control it. Internal, we can control them, okay? We look at the process of risk management, importance of understanding the client's approach to risk, and what do we mean by top-down approach, and what do we understand, how do we understand audit planning and its implication for audit-based risk-based auditing, and they need to conduct substantive testing in the statement of financial position. All right. Once again, this is a summary, okay? And you can see it on chapter 14. And then again, review the whole of chapter 5 to 8 in the ACCA text. Chapter 14 of the core text and chapters 5 to 8 will cover the heart of evidence gathering when we come to auditing, okay, in our module. Risk and financial statements. Auditor is always concerned that there's some risk operating or concerning the firm, the company, and this risk can have a rippling effect on the financial statements. So the auditor must always gauge how does that business risk or those risks affect the financial statement. How do they do that? How can they gauge? First, they need to look at the ability of the company to meet its goals and objectives. So it could also mean evaluating the responsibilities and what management has done to ensure that they have met the objectives and goals of the company. In that case, if we're able to achieve that satisfactorily, the audit is able to determine whether the company has the ability to continue as a going concern. Okay, these two things will guide us. Now, risk, as we all know, would always think it is a negative consequence that befalls a company for some reason. Sometimes it is their own doing, sometimes it is outside their scope. Okay, COVID imposes a terrible risk both on the business operations. When COVID occurred, you know, some businesses have to run out of business. They left. They couldn't survive because, I mean, life is important than cash. Okay, so they have to go out of business. And sometimes you don't get people coming to patronize your goods and services. To date, COVID has had some terrible effects on companies. Okay, look at the Russian-Ukraine war. It's not the energy firms doing. It is something outside of their scope. They cannot control it. So these are external sources of business risk. Okay, so usually we want to see what is the outcome of the risk on the company, and it will always, or it may always deviate from what we were expecting. We were expecting to make 10 million sales in the whole year of 2020. Then lockdown came. We couldn't even achieve 10% of it. That's a risk. Okay. We also call something the downside risk, which is also known as, okay, pure risk. And normally it is associated to bad things happening as a result of some catastrophic event. So people dying as a result of COVID is a downside risk, okay? We losing cash as a result of COVID. We are going out of business as a result of COVID. We are shutting down our operations. Energy firms are shutting down their operations because of rising cost of running their energy companies. There's a price cap they cannot go beyond. They cannot meet their current obligations, run out of business. Downside risk, okay? So risk also looks at the future outcomes, the probability that it will occur, okay? So we weigh it. We weigh the options and see what's the probability that it will occur, and if it occurs, what will be the impact on the operations of the company. We need to always analyze this risk, probability of it occurring, and then impact if it should occur. And if the probability is high, impact is high, avoid it. Avoid it. If probability is high, but impact is low, we can tolerate it, okay? If probability is low, but impact is high, we transfer the risk. If probability is low, impact is low, we accept it. That is where the TARA model comes in. You remember the TARA model, okay? All right, so analyze the risk. That's what we normally talk about in terms of risk mapping, and assess the risk exposure to the company. Then as an auditor, or even as a firm, we can design interventions to deal with that exposure, okay? How do we assess risk? Every situation is different. We cannot align the risk inherent in the HR operations to the risk inherent in the production operations. So it is the management's responsibility to assess each situation based on its merits and demerits differently. Of course, some may have a cross-cutting feature, okay? That one we just leverage on what we've already done in the past. So as the director's responsibility to manage risk, then we will have to examine to what extent have they managed risk. Okay, do they have a risk management policy and strategy? All right, so what they have to do as directors and management, they look at the changes in the business activity over the period. It is their role to do that. They should look at changes in financing options, okay? Also look at any increased exposure to business risks. Is there high competition out there? Are we losing key management staff? Are they leaving to join others? What is the reason? Okay, can we survive into the future period? Are we able to meet our borrowing costs? We've taken some loans. Are we able to service them? Okay, consider all those things. Are there changes in legislations, laws, and regulations that could impact our operations? Any future concerns? Okay, look at all this. They could also compare outcomes of the original budget to what has actually occurred, and what does this indicate for the future? Okay, so each one and its own case. We cannot apply all of this to one scenario, each one and its case. So like I said, the organization must have a risk management strategy. Usually should be a policy. And then we, the auditors, will review and see whether it makes sense and it meets the current needs, okay? Now, to be able to understand better, submerge yourself as a director, okay? Though independent, and see whether what they have done makes a lot of sense, okay? Now, question any assumptions that management has made when they were assessing the risk, when they were recording the risk, when they were putting down this policy. So that's why I said, put yourself in the shoes of the management and try and see whether what they said is reasonable and makes sense. Question it, okay? So it should be embedded in their systems, their policies. We must have a risk management strategy, policy. Every organization has one. Every meaningful, viable organization has one. How do we manage risk? Review the organizational objectives. Should we revise it? Should we maintain it? Should we add more to it? And carry out your risk assessments and report it in the form of a risk register. So there should always be a risk register that should record every risk as it occurs, whether the risk is of a higher magnitude, lower magnitude, or moderately. Manage it, record them. Because, you know, a lower risk today could jump up to become a significant risk in future. So that's why it's important that even if the risk is insignificant, report it, record it in the risk register, okay? And decide, how do we deal with this reported risk, okay? Should we avoid, transfer, accept, tolerate? What should we do, okay? Use a Tara model. And then, of course, listen to this. No organization can eliminate all its risk. There will always be what we call residual risk. You cannot eliminate everything. See, fraud, for example, whatever human beings are, there's fraud. You cannot eliminate fraud risk totally from the organization. There will be some bits and pieces that will remain with us for life, okay? So those residual risks, report them, note them down, okay? They keep changing anyway, they keep changing, but make sure they don't metamorphose into significant and great risk, okay? Monitor this risk, and of course, the internal audit function is the best function equipped to manage this risk, okay? Like I said, let us conduct a risk mapping and check the likelihood of it occurring and the probability of it occurring. High probability, high impact, avoid it. High probability, low impact. What do? Tolerate. All of the low impact, tolerate. Low impact, accept. Okay, high impact, avoid. High impact, ensure. So high probability, high impact, avoid. High probability, low impact, you can tolerate, okay? Low probability, low impact, accept it. Low probability, high impact, you transfer as insurance, okay? So we know what inherent risk is. I said it in the earlier slide, okay? Or in the earlier discussion. So I will not go in. Once I say inherent risk, I believe you understand it. So inherent risk in any situation could be there, okay? Because if we don't have controls in payroll systems, for example, we should know that there could be likelihood of fraud risk in the payroll functions, in the payroll systems. So uncertainty would always arise when we don't have information or knowledge about the situation. Therefore, futures cannot be predicted from uncertainty. You're not sure of the future. How can you predict it? Okay. So we must always ensure that we have some knowledge about what is happening. If there's no control at all, we must institute something, at least if it is on paper and it's not been implemented. We can use that as a starting point, okay, to reduce this inherent risk. Risk has strategic as well as immediate implications. So overall, the future going concern status of the organization could be impacted by risk. And currently, it could also impact the risk. So short-term effects and medium to longer term effects are all inherent within risk and uncertainty. Okay, I'll give you these assignments. Go back and ask yourself, what is the difference between risk and uncertainty? What is the difference between risk and threats? What is the difference between uncertainty and threats? Are they the same? Okay. What's the difference between risk versus uncertainty? Difference between risks and threats. They're not the same. And difference between what? Uncertainty and threats. They're not the same, okay? As a 315, like I said, how do we do this? Inquiry, talk to the management, ask them questions, conduct analytical review procedures, okay? Consider the relationship between numbers and non-financial data, ask questions. If necessary, inspect the sources of information, like vouching, and observe proceedings to see whether it is in line with laid down procedures or established rules and standard operating procedures, okay? How do we do this? Internal audit report, like I said, they are best equipped to identify risk and to help manage risk in the organization. Your previous experience with the audit client is good. If you're a new auditor, leverage on the information or the knowledge of the previous auditor, and you better understand this risk, okay? Screening is important. Screen the information you've been given and conduct some preliminary assessment of the systems, okay? Like I said, business risk comes from two sources, internal and external. Consider the internal. A lot of them, okay? So I'll not spend so much time. I'll ask you to review this. So competition from external folks, okay? Obsolescence of our products, failure to innovate or to adapt to new technologies, changes in the market, environmental legislations could also impact us, okay? Changes in attitudes and fashion of customers. When we lose our reputation, technological changes, we are not adapting. Loss of raw materials, how can we then produce finished products? Economic risk, today we have inflation, okay? We have higher cost of living going up. Vulnerable supply chain, increased global competition from low-cost suppliers. Internal, CEO dominates, poor corporate governance, bad customer feedback on social media could impact us, poor marketing skills within, employees are going on strike, railway workers, teachers are going on strike, lack of investment in new technologies, wrong strategy, it doesn't apply to our objectives, gearing is poor, okay, cash flow is not effective, not getting the cash. What else? Reliance on one customer or supplier. What if he leaves us? Failure of our financial systems. IT risk forms, it can be a distinct part of a risk, okay? But remember, IT risks are actually part of the risk that could affect the organization. Now, when you go to chapter 14 of the text, it gives you a number of risks, external risks that can hit the company, okay? Then a number of internal risks that could also hit the company. I want you to look at all of this, but listen, they are all business risks. They are all business risks, okay? So strategic risk, look at your IT strategy. Does it fit purpose? Do we have the situation where people are always hacking into our email system? Our data security is not the best. Today, our systems are crashing. You want to log on and nothing is working. You can't download. It takes you hours to download. Broadband is not stable. What about the one who is providing us, the service provider? Does it support us? When we call them instantly, do we get them, or it takes hours before they respond to our needs? Do we have an alternative backup plan for our IT devices, like a remote business continuity support plan, so that when we lose everything, we can get it from the backups clouds? Today we have OneDrive, we have iDrive, name them, Google Drive. Do we have all of this in place? Okay, so we need to consider these IT risks. Financial statement risk is the risk that there could be an error in our financial statement or misstatement. It could be because this misstatement has occurred because of error or because of fraud, okay? So what we have to do is that areas that could lead to misstatement, the technical areas like financial instruments, the financial instrument evaluation. Sometimes even employee benefits, looking at the pension scheme systems, okay, the plan benefits scheme, then the contribution schemes, okay, look at those ones. Sometimes they can be complicated a little. Share-based options evaluations, share pricing schemes, they could be quite complex if you're not careful. Now, the client should have the incentive, the ability to manipulate the financial statement if he thinks that this could benefit him. He doesn't care. So we should always have that suspicion that, listen, the client, if he makes an error and it's taking him forever to correct it, if there's a fraud he's committed and it's taking him forever to resolve it, he can manipulate the financials, okay? He can always manipulate the financials. So examples, like I said, look at provisions, IAS 37, look at the financial instruments sections, okay? There could be some misstatements, especially with estimates. People could always plug in something. Even with assets, okay? They want to capitalize expenses against IAS 38, intangible assets. When they know that they've internally generated the goodwill, they want to capitalize it because they think it's an asset, okay? But does it meet the pirate criteria? You learned this in FA2, right? You should know this, all right. They may have falsified income. Look at those areas. The client responds to these assessed risks. We want the company to be resilient, okay? So as an auditor, consider looking for indicators that shows that the company is resilient to risks, okay? Corporate resilience is considered or defined as the ability of the company to anticipate that there's risk that would occur. They then prepare for those risks and they respond to the risks. If they realize they cannot overcome those risks, they adapt to some changes so that when the risk occurs, the company can still survive. That's corporate resilience, okay? So we need to be sure that the company has developed resilient corporate resilient practices as comprehensive as possible, where they've identified all the risks and they have also demonstrated the ability to cope with these risks. Whether it is a slow risk that developed to a catastrophic one, or whether it came suddenly, okay? How did they respond? There should always be some corporate resilience plan, okay? So we must ensure that as auditors, we must ensure that the management has considered not only the routine risks that occur, but other familiar risks and threats that are not familiar, which come suddenly and we don't know where they are coming from. A number of questions we should ask, okay? This is a checklist, not comprehensive. There could be more, okay? For implications, okay? A number of questions we should ask. Is there a strong control environment? Does the management have an effective risk management process? The assumptions underlying their risk management strategy. Sometimes you hear RMP, formal RMP, risk management plan that they have in place. The assumptions they have set. Does it make sense? Okay. Have they managed this risk effectively? Did they transfer some? Was it transferable? Does it make sense? Couldn't they have tolerated it? The business, is it complex? Their transactions, is it complex? Do they have a strong management information systems, including some accounting information systems, okay, data management systems? Look at all of this. Any going concern issues? Are there some hanging litigation claims that could knock this company out of business? Cash flow issues. Do they have the customers? Do they pay on time? Do we have access to cash, or we are just relying on overdrafts and loans and borrowings? Is there any high fraud risk? Okay, any related parties with different agendas who wants to do their own thing without considering what will happen to the longer term prospects of the company? Any litigation claims, like I said, any risk of withdrawal of financial support from lenders and customers? Okay. All right, I'm looking at my time, but we can finish this. Let's finish it. Now, audit risk issues. So once this happens, there could be possible misstatements. Okay, once the risks are so much and it is overwhelming, there could be possible misstatements on the financials. Okay, why? Because controls were not there effectively to manage the risk, or the controls are there but they are poor. Okay, working capital shortage could be caused too often by rapid expansions, so that could also be an audit risk we need to consider. Okay, suppression of liabilities, it happens, and when you look at some of the real auditing world or world of auditing, you see examples of these clients being audited and they try to suppress liabilities, management fraud, okay, related party transactions and activities, going concern issues, computer failures, IT risks, okay, and other regulatory issues or litigation issues that may have been burdening the organization. So these are audit risk areas we need to consider, so that at the end of the day, we don't end up drawing wrong conclusions or issuing a wrong opinion. Okay. Now, the heart of what we were dealing with. So all the preambles deals with risk, business risk, okay, and its analysis and management. Now, in our situation now, companies have become complex. So fraud is becoming rampant and quite beautiful. People commit it, you don't find it. Financial statements are now cooked and misstated. Okay. Systems are now using computer-based approaches, global internalizations, okay, internationalization, okay. So we have multinationals. At the click of a button today, a transaction is posted in the US, in Ukraine, in somewhere in China. Audit firms are always getting the pressure from audit committees to keep their audit fees down. Of course, I mean, everybody wants to save some money. So if this is happening, what should I do? Should I go in and then do a comprehensive everything? I'm not saying we shouldn't do comprehensive work. We need to do that, but we need to be smart as well, okay? Audit areas of highest perceived risks are there. Okay, so in this case, given the complexity of companies, IT risk, growing internationalizations and pressures to keep fees down, we need to focus our attention on higher risk areas, okay? So areas we perceive to be higher risk, that's where we focus our attention and we do the audit. Those with lower risk, less attention, lower attention. Doesn't mean we shouldn't do it at all. We should devote some few little time there. Because at the end of the day, a lower risk area could evolve to become a higher risk area, okay? Risk assessment should then be based on audit risk or the business risk, okay? Business risk or audit risk. Now, the audit approach, as an auditor, I need to make my own evaluation of what management have told me or what management has presented to me. I can place myself in their shoes as usual and ask myself, have I identified, assessed, and addressed the risks due to the nature and complexity? Okay, have I addressed any issues of misstatement as a result of failures by the system to detect this risk? Or maybe the system is not comprehensive enough to detect risks. So that's what I would do as an auditor, okay? Now, where the entity's risk assessment process is appropriate to the entity's circumstances, considering the nature and complexity of the entity, is a matter of professional judgment. So what they've presented to me as management, I read it, I submerge myself into their shoes and do these assessments. It's all about my professional judgment to say they did a clean job, they did a reasonable job, they did a poor job, okay? And I justify the reason why, okay? Audit approach to risk, once again, the auditor's assessment of inherent risk may also influence the identification of both simple and complex controls, okay? Now, the auditor must identify these controls to areas which are of higher risk to the company. Sometimes they may not be quite open for us to see. We need to dig deeper, okay? And at this level, we must then assess the inherent risk at the assertion level, at each assertion level. So if it is the income statement at the assertion level, okay? Check whether it's complete, accurate, okay? And even cut off, okay, at each assertion level. The auditor's evaluation of the control environment as it relates to the use of its IT systems. And that you always find it in this part of our world or nowadays. The risks related to IT function itself, the risk related to the use of IT in the financial system. So is it robust, or somebody can easily go through the system and play his own cards, okay? So we must evaluate the risk that pertains to the IT and look at the controls designed to address these. That's why today in most audit firms, there's always an IT division who will come and join the main auditors and conduct IT assurance over the systems, okay? Because back in KPMG, and I know still they do it, they always have the IT auditors. So we let me say, mechanical guys will go, but the IT auditors come and provide a full assurance of the IT system, because it is based on the system that we are picking the figures, the financials, okay, to audit. Now, the advantages of conducting a business risk approach for our audit is that we reduce the chances of errors that may come up, or even the overall chance of issuing an audit risk, or issuing an inappropriate audit opinion. We reduce the audit risk to a bare minimum, okay? So processing errors rarely cause of audit problems, okay? They normally will be the rare cause of it if we have conducted our audit based on this business risk approach, okay? Major problems will arise because of going concern, management fraud, major systems breakdown. So if we conduct it based on the risk-based approach, we are able to determine these areas that will be of concern to the organization. It also helps us to understand the business and its environment and assess and identify risk of misstatements, and helps us to focus on high-risk areas. We add value to the audit, okay? There's a CEO I was talking to, he said, listen, I like your audit because you guys come in not just to look at the numbers and go, you add value to my organization. So I spend less money or no money to review my risk management plan, because your recommendations, your inputs alone helps me to revise my risk management plan, okay? It can be cheaper, it can be more efficient, like I said, so the CEOs will benefit from it, okay? Even to the audit firms, they will benefit from it, because we focus on higher risk areas instead of doing a comprehensive work which could add no value. It helps us to make use of data analytics, and partners and senior managers who get involved in the planning stage, because they know we are dealing with risk-based. They have the understanding, the partners, the senior managers. So they come in and guide us at the planning stage so that we can do something holistic, okay, something efficient. You get them right at the initiation point. And then corporate governance issues are brought into more prominence. Disadvantage, we need experienced staff. Do the audit partners and senior managers have time to stay in the planning process? Do they even have time to come and guide us during the field work? Emphasis is more on adding value to the services, okay? To combat identify risk and compromise independence. So if we are not careful, we are thinking of just going to work as a shadow consultant to the client. We may end up putting ourselves in the shoes of the client or the management and never remove our legs from the shoes of the management. So we end up behaving as if the company is ours, the client is ours, okay? The method that we auditors use, methodology, it depends on each audit firm, but generally, what auditors will consider is that what could lead to material misstatements, and what can audits contribute to the company achieving their goals, okay? So it's very important that we design and perform this risk assessment in a way which is not biased, okay, towards producing evidence that's corroborative, nor towards excluding evidence that is contradictory, okay? So in each case, make sure that we are providing evidence which is corroborative and not biased, okay? Evidence that's not contradictory, okay? So the independence issue comes in, you are auditing, you are still providing value, okay? So be careful what you are doing is not providing more of an advocacy at the same time issuing an opinion, okay? So be free from bias, but do your work perfectly to support your opinion. Top-down approach, we're coming to an end to the slides, to the video. So similar to business risk, with testing controls, okay, and controls will be tested at the higher level. If controls testing is confined to the higher level controls, substantive testing will be reduced. Okay. So especially when we realize that the controls at the higher levels are strong, are robust, they are very good. Okay. So normally when we talk of a top-down approach, we start at the business level, their strategic mandates, their objectives, and then we drill down to how it affects the financial statement at the transaction level, top-down. Okay. Down-up approach would have been transaction level through to where the company is able to achieve their objectives. But I want to look at it from the top and how it drills down. Okay. So check, has the financial statements helped the management to achieve their objectives? Okay. How does it flow through? Okay. It's like a directional testing, but actually from the top to the down. So top-down approach will concentrate on higher level controls by management, look at controls at the senior level, at the control environment level, corporate governance, okay? Conduct a lot of analytical reviews, ask questions, prove that they are working. If they are not working, of course, you do more substantive testing. But if they are working, substantive testing is reduced. You can never say, I won't do substantive testing at all. You must always do some substantive testing. And then we must report. We'll come to reporting on its own. ISA 700, we'll come to reporting on its own. But let's just quickly run through. So forming an opinion, and reporting on financial statements. In our audit report, we must provide an explanation telling the reader or the user of the report the extent to which our audit was capable of detecting irregularities and fraud in our report. Okay. So the business risk approach should involve sufficient work to provide assurance that our audit was able to detect irregularities and fraud, to detect irregularities arising from inherent risks, okay? Telling the reader that the controls in the systems are effective or they are not, and also telling the nature, the timing, and extent of our audit procedures, okay? You always hear this, nature, timing, and extent of the audit procedures, okay? So that's it. Burlington Publishing PLC, page 240. There's a case study there. Again, as usual, 241, page 241 of the core text, you'll find some student self-testing questions. And like I said, it's important, and it is the heart of the course we are doing, evidence, okay? Unit 4, very important, okay? ACCA text chapters 5 to 8, very important, okay? And it is important that as you, being a student of auditing, you should be able to identify and assess business risk affecting an organization. There's two past ACCA exams questions. I would want you to look at them on pages 241 to 242. All right, I'm gonna end here. Sorry, I've gone past the usual 30, 35 minutes. We've gone into 40 minutes, but it's important, okay? I'll see you in the next slide, in the next video. Okay, bye for now.